Good evening, I'm Jim Scheinberg. I'm the managing partner of North Pier Fiduciary Management. Thank you all for coming this evening to our first quarterly get-together at the Marina City Club. We're going to be giving a review on what's going on in the economy, as well as the recent activities in the capital markets, as well as some theories that we have on where we might be in a really broad macro cycle, some similarities that we're seeing to a day long past that we'll get into in a minute. Ultimately, where we see ourselves, and obviously we've had quite a bit of a run-up in the U.S. equity markets here and actually the global equity markets as a whole over the prior 11 months, 12 months since Donald Trump's been elected. And a lot of people are starting to ask, how far can this market run? How long can the economy sustain its current growth rate? And a lot of times those comparisons are being made to how long it's been since the recovery started. And in fact, we actually think that that analysis might be a little bit off. We think that it's quite possible that for the past 8 years prior to 2017, that the economy hasn't really been in full recovery and the typical earmarks of what a recovery would look like. And it wasn't really until recently that the traditional types of behaviors in corporate America and investors and in consumers really hasn't started to act like a recovery until just very recently. And we really do believe that the period of time that we find ourselves in might closely resemble the period of time following the end of World War I and the bringing in of what was known as the Roaring Twenties. There was a very specific embarkation right in 1920 during the election that looked remarkably similar to where we find ourselves in the United States today, or more better stated, where we found ourselves about a year ago. Back then, a gentleman by the name of Warren Harding was elected. Similar to Trump, he ran on a nationalist and nostalgic type of a campaign. His campaign slogan was actually a return to normalcy. Obviously, Donald Trump's was to make America great again, but when you think about it, those are two very similar concepts. It's hearkening on a time that things were better in the past and trying to bring those old-time good times back to the present day. Both of them, interestingly enough, were elected out of a very divided Republican field. Just like Donald Trump faced a tremendous amount of opposition from party standard bearers like Jeb Bush, and then of course the folks that he had, the closer runoffs with, like Ted Cruz, folks that were party establishment. Warren Harding actually ran against 12 different candidates in the Republican primary, and in fact, the convention in 1920 saw Harding face so much competition that in the first 8 ballots, he never polled more than 10%. So he was a dark horse, if you will, back in the first several rounds, and there were several frontrunners that were considered to be favorites to win the nomination. It didn't happen until much later in that process that Harding was kind of a compromise candidate, if you will. Not exactly the same way that Donald Trump reached the nomination, but the conditions were the same. Trump really garnered his support not because he was garnering 60 or 70% of the vote, but because the people who were expected to win were in fact in a situation where they were starting to split the votes. So here we are today. We have a president-elect, or a president who was elected in a contested primary, and the similarities don't stop there. Both of them actually used the media largely to get elected. President Harding was actually a newspaper owner and was very used to working with the press and had a lot of ties in the press. And in fact, when he ran in 1920, he did it what was known as his porch front campaign. He pretty much stayed at home most of the time and utilized the national press to get his word out when he was running. Not exactly the same thing that Donald Trump did, but obviously Donald Trump being in a position of where he was reality TV star, really knew how to utilize the press, knew what the press was interested in, knew what America was interested in the media, and was able to really beat those drums. And obviously that created somewhat of a groundswell that got him the votes that he did. So a lot of similarities between 1920 and Harding getting elected, as well as Trump. The biggest one, of course, is the nationalistic theme. Back in 1920, the Republican convention and Harding himself were in support of the United States not actually joining the League of Nations, which later became the UN. In addition to that, as that presidency went on, and then subsequent presidencies in the 1920, immigration was fought and then cut, because we had a lot of immigrants that came into the country the 2 decades prior to that. And in addition to that, we had a large increase in the amount of tariffs. Similarly to the way that Donald Trump ran on the build the wall rhetoric, talking about withdrawing from NATO, certainly cutting back immigration. We've seen those policies put forward recently. And then in addition to that, the talk of border taxes and really possibly creating some trade wars. So ultimately the parallels between the Trump election and the Harding election, very, very similar in the way they came to office. But it's also important to take a look at the period of time in which they were elected. So when Harding came into office, we had just finished off an era that was specifically known as the Progressive Era. During that time period, we had women gain the right to vote with the 19th Amendment under women's suffrage. We had substantial gains in child labor laws and in labor laws as a whole. The institution of workman's comp insurance started during that time period. And then that was also the period of time where we saw a big rise in the unions. Similarly to women's suffrage, we saw the rise of same-sex rights in the United States and the legalization of same-sex marriage, minimum wage increases across the country. You had Bernie Sanders calling for a $15 national minimum wage across the board, workplace equality. These types of things that were on the rise during the Obama administration's 8 years. Very similar parallels if you look at the social reforms that were going on prior to William Harding being elected. But with those good things that came during that period of time of government intervening, if you will, in society, we also, back prior to 1920, had the advent of the Federal Reserve, a monetary control system, if you will, and that was in reaction to the panic and the crisis of 1907. We had the institution of a federal tax. And of course, the biggest intrusion into the lives of common Americans was prohibition that came in. So, with these good programs that the government was bringing in at that point in time, you also had, as we say, government knows best, or big brother in the room, also feeling that they had a say in other areas that some people in America didn't particularly appreciate at that point in time. In addition to that, parallel, we see, obviously recently and during the prior years before Donald Trump got elected, substantial bailouts for Wall Street, mortgages for individual homeowners, Federal Reserve, massive intervention from the Federal Reserve, the advent of Obamacare, and then the increasingly growing wave of political correctness. Similar to the morality that came about during the Prohibition phase, we also have this sense of common morality that's been propagated, and that has reached quite the fevered pitch. So much so that when Donald Trump got elected, his very brash approach to his campaign really pierced right through that and created this shift, this sea change for part of America enough that he garnered enough votes to become the sitting president. It's important to really get into what ultimately resulted from this period of time. So you had regulations on the rise prior to the 1920s. You had substantial regulation increases during the era that we find ourselves in right now. And with Donald Trump and also William Harding coming into the office, we have an easing and a rolling back of a lot of those regulations. We have a reduction in taxes after a period of time in which they rose. You have union membership declined, massive roll-ins of unions prior to 1920. From 1920 to 1929, union membership fell from about 18% of the workforce down to about 10, almost half. And at the same time, as you're rolling back these impediments to the economy, you're actually getting a new optimism that's growing in America. And so as we saw the 1920s unfold, from 1920 to 1929, we saw GDP rise an average of 4.7% a year. I think we'd all really like to see that kind of growth in the United States over the next 9 years. The stock market actually tripled during that time period. So with that GDP growth, you have earnings better than doubling in the United States from 1921 to 1929. And so you have this period where really everybody's benefiting. Presently, obviously, we've had quite a run on the market here in the last 12 months. We have an easing of regulations, Dodd-Frank, getting essentially depowered, considered to be an incredibly intrusive banking regulation that was more reactionary instead of prescriptive to solving problems. We have the FCC with net neutrality. You have some deregulation going on there, deregulation at the EPA. Some of it may be good, some of it possibly might be overreaching, but nonetheless, it's certainly positive for certain aspects of business. And then possibly some kind of a repeal, replace, reshaping, repowering of ACA, of Obamacare. And forward-looking, we do expect that eventually there'll be some form, with the Republicans' control of both the House and the Senate, as well as the White House, that we will get some kind of tax reform, and that should also be stimulative to the economy, similar to what we saw in the 1920s. So a lot of parallels there, a lot of parallels. We're going to come back to that in a moment, but I just wanted you to take a look at this moment in time, because for those who think that we're sitting at the peak, if you will, of a long-standing economic recovery, at North Pier, we feel that there's good evidence that, in fact, that we may actually just be beginning. So let's take a look at the numbers. Business-to-business activity in the United States is booming right now. It's really hitting on all cylinders. The recent release from the Institute of Supply Management, that's a poll that goes out to purchasing managers every single month, shows that the reports on business conditions here in the United States, on both the manufacturing side as well as the services side, has been incredibly robust and optimistic. As a matter of fact, we've just recently set a 17-year high in the numbers that we have coming out from the ISM. What that indicates, and this is a shocking number and completely contradictory to the numbers that we're getting out of the US government, most of Wall Street, the IMF, you name it, the World Bank, all looking for the US economy to grow somewhere in the mid 2% next year. The ISM forecast is showing somewhere between 4.2 and 5.5% in terms of GDP growth next year. Now, if we were to just get half of that spread back, it would be an incredible outperformance to expectations in the system, and you could definitely see how that would potentially lead to substantially higher equity values here in the United States, which would most likely be led by higher corporate profits during that time period. Here we have the situation with unemployment right now. Clearly, the labor force is in full swing. Unemployment has ratcheted down to 4.2%. We've had some varying short-term data, weekly data numbers that have come in the wake of the hurricanes. But in terms of the broader aspects of unemployment, I think consensus is well formed that we're looking at a fully employed scenario. 4.2% represents a full employment basis. If really, once you get down below 4, really down below 4.2, you get into overemployment, which is not necessarily good for the economy. It means you're overpaying for unskilled workers. We're already starting to see some evidence of that. I think, Doug, you had mentioned that to me just recently, that there's some anecdotal evidence out there that's showing that there's actually a shortage of skilled workers in America today, and that could get worse if you see unemployment ratchet itself down even more. But presently, certainly for workers in America, jobs are aplenty. Real wages, which have been largely argued to have been stagnant during most of the prior decade, have been growing in excess of 2% now for approximately 3 years, and are now approaching 3% year-over-year real return. So workers in America are starting to get substantial wage increases. You put those two things together, and the average American is feeling quite confident. If you look at the consumer confidence reports that are out there, They're both hitting record highs. You've got the University of Michigan sentiment number. You have the Consumer Confidence Index out of the Conference Board, both showing 17-year highs. Very optimistic about current situations. Present situations are always more optimistic than future expectations at this point in the cycle, but both of them are rising quite a bit. And we expect that that's going to continue to show itself in the form of consumer spending. Here we are, we're in October. We're very close to the Christmas season. Black Friday is about a month away from right now. And we would not bet against a very strong Christmas this year. We think that Christmas is likely to end up being a gangbuster. And that confidence, those extra wages, likely to bear out in high sales for consumers. That's going to be aided, in addition to that, with home values that have been increasing very steadily in about a 5 to 6% range, very consistently now for almost 5 years, 4 to 5 years. Incredibly small amounts of volatility, and largely that's attributed to the fact that there's very little supply on the market right now. Only about a 4.2% month supply of homes that are on the market right now in terms of the amount of monthly sales and the amount of homes that are outstanding. You go ahead and you divide that out, and it's about a 4.2 month supply of homes on the market. Equilibrium is considered to be about 6.5%, or 6 to 6.5 months. And we've been at that kind of shortage in supply in the marketplace for about that whole entire time frame. As long as that supply level stays short, you're going to continue to see these kind of gains over and over. And obviously, this is not a one-size-fits-all kind of thing. We've got markets that are doing better than others in the United States. Some of them are trading places, but largely the United States is generally participating in this very consistent and moderate advance. Nothing that's bubble-like in the real estate sector of the economy right now. So when people feel confident about their home prices going up, and they feel confident about their wages going up, and that jobs are aplenty, they feel very comfortable going out and spending money. And we've seen that. We've seen that in things along the lines of home improvement costs and washing machine sales, car sales, all the way down the line to hopefully a strong Christmas. So, one of the things that the Fed has been watching here recently and has, up until about a year ago, used as an indicator that they didn't need to raise interest rates, was that inflation was very moderate. We had small little peaks, if you will, of where inflation seemed to be raising its head, but they all seem to abate for some reason or another. But we think that at this particular point in the cycle, the inflationary numbers that we're getting right now are for real. We think that they're sustainable, and we think this is the inflection point. The Fed has been trying to get inflation up above the 2% or to the 2% level now for a few years. Finally, we think that A, that they're there, and B, they may get a little bit more than what they were looking for. You've got PPI producer prices up 2.6% year over year. It's based on a 0.5% increase just last month. It's a big number. CPI, which normally trails PPI by a little bit, that's the prices that consumers are paying, just pierced the 2% mark as well, 2.2% year over year. And what we're seeing here is we're seeing wages going up, we're seeing benefits going up. We were talking about how good that is if you're a consumer, if you're a normal American, but if you're a business owner, if you're corporate America, you don't want wages getting too far ahead of themselves. And this wage growth that we're starting to see, if it continues to be at these levels or even accelerates from here, could in fact end up being somewhat of a headwind for economic advancement going forward from a corporate perspective. In addition to that, we've had raw material costs on the rise. Because things are kind of sloshing around in the commodity sector and commodities are not up this year, a lot of people haven't paid attention to commodities, but in fact, the industrial commodities actually have appreciated quite a bit. Copper and aluminum prices are up almost 25% year over year. So the industrial materials are appreciating at the same time that food costs have been coming down, and they've been kind of evening out and kind of hiding the advance in commodities. But when you get raw material increases, that speaks obviously to the manufacturing sector. So when materials go up, when labor goes up, you're likely looking at higher prices going forward. And so this 2.2 to 2.6% range that we're seeing in CPI and PPI, that might be the beginning of something a little bit more severe. So certainly a challenge for the Federal Reserve to make sure that they don't kill the advance in the economy, if they could, and at the same time that they don't want to be too far behind the inflationary curve that we get runaway inflation, because that's not good for anybody. Speaking of the Fed, so Janet Yellen's term is up February 1st. Right now, literally this week as we speak, Donald Trump is weighing his options. There are presently 5 candidates on the table. Interestingly enough, 2 of them are considered to be substantially hawkish compared to where the Fed is right now, and don't support and have been vocal critics, actually, of the elongated period of time that we've had low interest rate policy coming out of the Fed. John Taylor, who's a Stanford economics professor, and Kevin Warsh, who's a former Fed governor, are both being considered. Donald Trump will make that decision. He's recently indicated that he may be considering just reappointing Janet Yellen for another term. But it is highly likely that one of those 2, if not both of those 2 gentlemen, will be appointed to Fed governorships. And it's important to remember that regardless of who becomes the Fed chair, ultimately the chair is only the chair. The Federal Reserve Open Markets Committee actually acts as a committee, and they have to vote with a majority in order to enact policy. So it's the Fed makeup is just as important as who ends up chairing it. Nonetheless, the indication is presently that the future direction of the Fed is going to become more and more hawkish on inflation, depending on how it gets composed. We might see it at the chair level, we might see it down in the membership, but it is quite likely that low-term interest rates are going to fade and become a thing of the past. Just to remind you, just going back, we don't have to go back far. If we just go back a couple of years after the financial crisis, Fed funds were hovering in the 2 to 3% range before they came down, and the 10-year Treasury was challenging 4.25% at one point in time. And so we've gotten used to this low interest rate environment, and we think that any kind of a ratchet up is going to kill the economy. But even if we were to rise a full 100 basis points on the full yield curve right here, we would still be well below norm, well below norm. So there's definitely room if history is any kind of an indicator. So just to go back to this concept, so here we are, obviously the economy looks very good, labor looks good, business conditions look good, the consumer is alive and well and healthy, and we could go through a litany of data to support this. There literally is, besides commodities being soft in some patches, there's really no area in the U.S. economy that we see any kind of cracks in that kind of a theory. And in fact, we're seeing the same thing in Europe as well. The European economies are doing much better than expected, and as a matter of fact, at North Pier, we think might even be a much better place to be looking for upside performance than even in the United States. So you look across the globe, things are pretty rosy. The question is, how long can they stay rosy? Well, the reality is if we go back to that story, we look at the parallels of the 1920s, we look at all the conditions that were on the table, the globe, as well as the United States, really benefited from this period of time of deregulation. So let's look and take a look and see how well things looked. As I mentioned, during the period of time from 1921 to 1929, the U.S. economy grew at 4.7% per year. And because we had a substantive amount of immigration during that period of time, the population was growing. We even looked at per capita increases in GDP, and the per capita number actually went up 3.2% per year during that time period. So it really was a rising tide lifts all ships kind of scenario. The only, just a side note, the only sector that didn't do well during that time period was the U.S. farming sector, because manufacturing was really starting to take the lead in the economy at the same time that farming was under challenge. So it wasn't necessarily great for everybody, but if you weren't a farmer in the United States, these were very good times. During that time period, during that 1921 and 1929 time period where the economy was growing at 4.7%, we saw corporate American profits double, literally double during that time period, better than double actually. So you can see that there's lots and lots of room for upside in corporate America. If you have that kind of upside GDP growth, you're going to get top line growth in revenue, you're going to get continued efficiencies out of corporate America that they continue to eke out of their earnings. A lot of opportunity for continued growth if you do get these projected numbers that we're starting to see out of the ISM. If you hit 4%, if you were to hit 4.5% at the low end of the ISM forecasts, you could see what kind of magnitude of an impact that might have on earnings in corporate America. And if earnings in corporate America go up that much, you're going to have stock prices appreciate. And speaking of stock prices, going back to the Roaring Twenties, I mean, obviously we know how that story ended. There was a lot of speculation in 1928 and 1929. But from 1921 to 1929, before that bubble burst, you had stocks better than triple in a 9-year period. And it's important to understand that if you get this confluence of upside opportunity, if you will, all coming together, and you get a continuance that lasts a few years, very possible, and however even more likely that you're going to get continuations of equity appreciation. S&P 500 earnings grew 18% year over year through this last quarter. They're forecasted to grow at 15% next year. So even though that the S&P 500 might be trading at 18 times earnings, which is high, it's approximately about 20% overvalued, or not overvalued, but 20% a premium, if you will, over long-term valuations. I won't use the word overvalued. We'll let history determine that. If we just held that level, and if things stay good, I would say that there's a high likelihood that you will hold that level or even advance it. If you just add 15% in earnings to the S&P 500, you can see that you could easily attain double-digit growth in equities for the next year. And then if you have multiple years of that scenario, it could continue. We're not saying that that will happen, but we are saying that history has shown that when you have these implements into the economy, especially after a period where you have things that are detractors from growth, that are impacting the economy, that mere relief that the wind is no longer in your face has a tendency to have some legs, and in the past has actually had legs that have lasted quite a long time. Looking forward, we have more impetus for stimulation to this economy. So here we've got earnings that have grown, and it's like, okay, things are great, and we've had deregulation, and people are a little more optimistic. So we've kind of had this relief rally and this relief growth, if you will, but how long could it last? The reality is that we have lots of things on the horizon that could extend it. We still have not worked our way through tax reform, and we definitely could see a meaningful cut to corporate tax rates. That would have a major implication on the value of equities. Anytime that you reprice something in terms of after-tax returns, if you raise taxes on it, its intrinsic value goes down. If you lower taxes on it, its intrinsic value goes up. So there's definitely a pop that could happen there. Some of that might be priced into the market. We've had a decline in the US dollar here over the last year. Dollar's down over 10% versus the euro, as an example, and a lower dollar is good for exports and can be good for the economy. So if the low dollar stays in place or even possibly sees a little more weakness, that can actually end up being a bolstering to the economy going forward. The prospects for further deregulation are definitely in the works. There's indications that the Trump presidency will continue to move in that direction. And again, deregulation is one of those things. If you're taking off overregulation or ineffective regulation, that can be good for the economy. If you end up doing long-term damage to certain aspects of the economy by deregulating, that can be a bad thing. But certainly in the near term, the relaxing of regulations has a tendency to be a bolstering of economic conditions. And then ultimately, this is kind of this rising tide lifts all ships scenario. If you look across the globe right now, there's not a lot of economies that don't seem to be participating in this boom. Europe seems to be doing quite well. Even the situation in South America with Brazil has stabilized to a certain extent. And if you look across the field and you say, well, Europe is doing better than expected, the United States and North America looks very good, the emerging markets are doing quite good, especially those resource-producing countries that I mentioned that might be benefiting from those mining costs that are going up, or I should say mining resource prices that are going up. You can see that this global recovery has legs, and it can start to feed on itself. We're just starting to see the beginning aspects. I mean, think about it. Since the Great Recession, since the financial crisis, we haven't had a point in time of where the economy is hitting on all cylinders across the globe. We're just now getting glimpses of that. So if we can get that kind of condition again, that can be sustainable, it can feed on itself. And if this type of a trend continues on for 2 or 3 or 4 or 5 or longer years, you can see that betting against the US and global stock market is probably not the best idea in the world. So prices could very well look very reasonable at this point in time if you get a continuation of that trend. As always at North Pier, we like to bring in the other shoe. There are other conditions that are out there. We think that they're a little further down the pipeline, but we can't take our eye off of them. The structural condition in the United States might be good presently, but at the end of the day, we do have a substantial debt load. Our government debt is still very, very high. We crossed $20 trillion this year. We have a very large amount of unfunded liability in the Social Security system, and the Medicare and the Medicaid system, entitlements. You look at Obamacare, quite possibly ACA will end up being very costly depending on what it ends up looking like. So all these things have a bill to pay at the end of the day. The question is, where does our viewpoint start to focus on the end of the day instead of the present day? Questions about what our economic stamina is in a higher interest rate world. I mean, if we end up with a Fed funds rate at 3%, if we end up with a Treasury rate at 5% for the 10-year, how can the economy operate during that environment, or possibly higher? I mean, remember, those are just getting back to normal levels. What if we were to go through a period of time where inflation hit us and we had to raise rates substantially? Or for that matter, there was even a degrading confidence in the US dollar as a fiat currency in and of itself, or a reserve currency in and of itself. You could see how things could shift very quickly. Again, probably much further down the road, but things that we should keep in our mind. The biggest concern, probably near term, is just overconfidence and speculation in the equity markets. When you see these valuations start to climb into the 1999-like levels, when we're talking about multiples in the 20s, and I think it hit 27 in 1999 or the end of 1999 times earnings. Obviously, there's a level where, regardless of how good the economy is, stock values just aren't attractive. We don't think we're there quite yet. But again, something that we should pay attention to, because if you get another year or two and you get GDP of 4% and 4%, I'm pretty confident to say that sobriety will not be in the room. And American investors may start to get a little tipsy at the party, so to speak. So you got to watch out for speculation. And ultimately, the biggest issue we think that is eventually got to come to roost is that baby boomers presently, statistically, are very ill prepared for retirement. And eventually, if not already, they will be what's known as, we have a new term in the industry called decumulation. We were talking about the accumulation cycle. As you put your nest egg away, baby boomers are entering the decumulation cycle, which means that they're starting to consume their wealth. Well, if they are selling their stocks and they are selling their bonds eventually in order to pay for mortgages, healthcare costs, et cetera, that's a natural seller in the market. Where are the natural buyers to meet them on the other end? If you get a supply-demand curve mismatch, that could be a very, very serious headwind for equity and bond prices, which could exacerbate that interest rate scenario I just told you about, and they all start to feed on themselves. So these are the things that we're watching for further down the horizon, and obviously if we see something that's troubling near term, we'll pay attention. And then, of course, this is I once heard the best quote that I've ever heard in my whole entire career is, it's always the thing you're not looking at that gets you. And besides what we went through in 2007 and 2008, where there was a pretty good forecast that the subprime loans were spilling over into other areas, in my 27-year career, there's only been one time that the thing we were looking at got us. All the other times it was the thing that we weren't looking at. So there's obviously going to be issues that may come up geopolitically, economically, that we can't possibly view, those black swan events, and that can always come into the room. But until then, we think that the present situation is one that has some fortitude to it. The U.S. economy, the global economy, labor, consumers, business-to-business activities, very, very solid ground, and likely to have some tailwinds going forward. So with that, I'll take any questions.